All right. So have you ever been on like a really long road trip and you need that map, to make sure you're going the right way and you're not going to run out of gas before you get there.
Yeah.
And that, you're staying on budget too. Well, businesses kind of have that same thing. They need a map and a budget, and it's all created using something called managerial accounting.
Well, that's a great way to think about it,
Yeah.
It's just like you need to plan your route and know how much gas you have to make it to where you're going. A business needs to have that same understanding of their own financial roadmap and the resources to get where they want to go.
Yeah, exactly. So today we're diving deep into this whole world of managerial accounting.
Okay.
All thanks to your request, of course, and this really helpful guide, Managerial Accounting for Dummies,
Oh,
by Mark P. Holtzman.
okay.
So think of this like our own personalized shortcut to understanding how businesses really keep track of their money, how they plan for the future, and then ultimately how they just make smarter decisions.
Yeah. And, it's not just those big companies that benefit from this kind of thinking.
Right.
Whether it's like a solo entrepreneur or a large corporation, like the basic principles of managerial accounting are really essential for any business that wants to, be successful.
Right. Absolutely. So forget the image of, those dusty old ledgers.
Yeah.
This is about real world, insights.
Yeah.
And we're going to look at how managerial accounting helps all kinds of companies from service-based businesses, like your favorite local salon or a freelance consultant to retailers like, the grocery store on the corner or your go-to clothing shop. And then, of course, manufacturers.
Yeah.
Everything from those huge auto plants all the way down to the bakery making your morning pastry.
Yeah, they all need it.
Yeah, they all need it.
Understand their financial engine.
Yeah.
Exactly.
To really understand, how things are working, behind the scenes.
Yeah, and we're going to break down some really, really useful concepts today, too, like how businesses analyze what things actually cost them,
Okay.
how they put together those, plans and budgets that are super important. And
Yeah.
we'll even talk about, the responsibilities that come with handling financial information within a company, which is really crucial.
Right. That's a big one, yeah.
Yeah,
So think of this as kind of getting, a behind the scenes look at the financial thinking that drives businesses.
absolutely.
So our goal today is to pull out those most valuable nuggets from this material,
Yeah,
give you a clear picture of what managerial accounting is all about, why it's important, and hopefully we'll do it without getting bogged down in too much jargon.
right. Keep it clear
Yeah, keep it clear.
for everybody.
Yeah. But get ready for some aha moments because we're going to connect these ideas back to the real world.
Oh, yeah, for sure.
Okay, so to kick us off, what exactly is managerial accounting?
So at its simplest, managerial accounting is all about gathering and keeping an eye on financial information within a company just to make sure that they're on the right track to hit those targets, to hit those goals. And I got to say, I really like your road trip analogy from earlier.
Oh, thanks.
It really does. It really does fit. Because it's about, planning the route, setting those financial goals, following the directions, which is like monitoring how you're doing. Are you hitting those goals or not? And it's like checking your fuel gauge along the way, making sure you're managing resources, keeping costs under control.
So it's more about looking forward and making decisions for the future rather than just looking back at what's already happened.
That is a great way to put it. Yes.
Okay. And what are some of the main things that someone working in managerial accounting would do? What are some of their key roles?
Well, a really, really important one is analyzing costs.
Okay.
So this involves, digging into all those different types of costs that businesses have, understanding, what makes them change, what are those cost drivers,
Right.
and how all those costs behave.
Right.
So, for example, if a company's making T-shirts, the cost of their cotton is probably going to go up if they're making more and more shirts.
Right.
Right. So knowing this helps them to predict what their expenses are going to be at different production levels.
Makes sense. You need to understand what's driving those costs if you want to be able to manage them. So what else is involved in managerial accounting?
Another big piece is planning and budgeting.
Okay.
So managerial accountants are really heavily involved in creating those financial blueprints that help a company to put their strategies into action and to reach those targets. And this covers everything from, predicting how much they're going to sell in the future,
Right.
to figuring out production schedules and forecasting, the cash that's coming in and the cash that's going out.
And we actually saw a really clear example of that in the book with Busy Hardware
Oh, yeah.
and their snow shovel order.
Yeah, exactly. They thought they were going to sell a certain number of snow shovels.
Right.
place an order. And then their managerial accountants, they were smart. They were keeping an eye on things like sales trends and the weather forecast and realized, whoa, we need to cancel that next shipment of snow
Yeah.
shovels. It's getting warm. Nobody's going to be buying them.
And you-
So that's a perfect example of how being proactive and using the insights from managerial accounting can really prevent a business from losing a lot of money.
Right.
It's all about, using financial intelligence to avoid those potential pitfalls.
Right, being financially nimble.
Exactly, yeah.
So you said there were 3 key roles. What was the third one?
Right. So the third really key area is evaluating and controlling operations.
Okay.
So this involves comparing how the business is actually doing financially to the plans and budgets that we just talked about making. So if there are, big differences, what we call variances, managerial accountants, they come in and they help investigate. They help figure out, why are these numbers so different from what we were expecting?
So they're kind of like the financial detectives of the company in a way.
I like that. Yeah,
Yeah.
they are. They're looking for those discrepancies. They're helping management understand, is the business, performing as we expected? And are there any areas that we need to improve? It could be anything from, inefficient production to costs that are suddenly higher than we were planning.
You mentioned defining costs earlier, and I feel like that sounds pretty simple, but is there actually more to it than just like, what a company pays for stuff?
Yeah, there is.
Like,
So at its most basic, a cost is anything that a company sacrifices financially to get something,
okay.
whether it's buying those raw materials or paying people to work, with the expectation that, this is going to lead to some future benefit, like making sales or increasing their overall profit. But costs, they're not all created equal. They've got different components. Remember that example we talked about with the can of root beer?
Right, the raw materials and the labor
Yeah.
and then the general overhead.
Exactly. So the raw materials are all the ingredients that go directly into that can.
Right.
So the water, the sugar, the flavorings,
Okay.
direct labor cost. That's what you're paying the people who are actually operating the machinery that's bottling up all that root beer.
Okay.
And then overhead, that covers all the other expenses for running the whole production facility.
Right.
So it's stuff like the rent for the factory, the utility bills, and the cost of keeping all that equipment in tip-top shape.
Okay.
We'll go into these different types of costs in more detail a bit later.
Okay, so we're starting to build a good foundation here of what managerial accounting is all about.
Yeah.
Now, the outline mentions that it's different from financial accounting. So how are they different?
That's a great question. It's an important distinction. So financial accounting, that's mainly focused on giving financial information to people outside the company,
Okay.
people like investors, banks, and those regulatory agencies. It has to follow a really strict set of rules,
Okay.
which are known as GAAP, generally accepted accounting principles, to make sure that those financial statements are consistent and comparable across different companies.
Okay.
Managerial accounting, on the other hand, that's specifically for the people making decisions inside the organization, the managers.
Okay.
It's much more flexible,
Okay.
and it's tailored to the specific needs of each company.
Mm.
So the information, it doesn't necessarily have to follow all those standard rules,
Right.
as long as it's useful for making informed decisions about that business.
So financial accounting is more about reporting to the outside world
Yeah,
and keeping score for investors,
right.
whereas managerial accounting is more about providing the internal intelligence to actually run and improve the business.
Exactly. Yeah.
Now, a point that really stood out to me in the first chapter was this idea of the importance of overhead allocation. So why is it so important for businesses to get this right?
What's fascinating here is how directly this impacts a company's ability to know which of its products or services are actually profitable.
Okay.
So overhead costs, remember, those are indirect costs.
Right.
They're not easily tied to a specific product, things like the rent on a factory or the electricity bill.
Right.
And if a company doesn't allocate these costs accurately to its different products or services, it can actually lead to some really bad decisions about pricing.
Okay.
They might end up charging too much for some things and losing sales to the competition, or even worse, they might underprice other items
Right.
and not make enough profit to cover their costs.
And the book mentioned that this is becoming even more important with all the automation that we're seeing in manufacturing these days.
Yeah, it totally is. If you think about how manufacturing is changing,
Yeah.
you see this huge move towards more automation and fewer people working directly on the production line.
Right.
And what this means is that overhead costs, like the costs of running and maintaining all that automated equipment, they're becoming a much bigger part of the total cost of production.
Okay.
So if a company is allocating all that overhead incorrectly,
Yeah.
it's going to have a way bigger impact on how they see the cost of each product.
Right.
It's not a small detail anymore.
Right.
Accurate overhead allocation, it's not just about having accurate costs.
Okay.
It's about making smart choices about which products are truly profitable and which ones might secretly be losing money.
Right.
Companies that get this wrong, they could actually be, unknowingly propping up unprofitable products
Right.
with the profits from their good ones.
Yeah, they're kind of subsidizing it without realizing it.
Exactly.
The outline also mentions relevant versus irrelevant costs. So it sounds like this is all about making smarter decisions.
It absolutely is.
Yeah.
So when managers are trying to decide between different options, they need to really focus on those costs that will actually change based on what they decide. Those are
Right.
the relevant costs.
Yeah, okay.
Irrelevant costs, on the other hand, are costs that stay the same no matter what they decide.
Okay.
So they shouldn't even really be a factor in the short-term choices.
Yeah, I thought the Cancun vacation example from the book was really helpful to illustrate this.
Yeah, me too. It's a good one.
So the cost of your plane ticket and your hotel in Cancun, those are directly tied to your decision to go on that specific trip.
Right.
They're relevant, but your regular car payment, that's something you have to pay no matter what.
Exactly.
So it doesn't change. So it's irrelevant to the vacation choice.
Exactly. Whether you're on the beach or at home, you're paying for that car.
Right, exactly. And what about the example with the bakery and the day-old cake? I thought that was a real aha moment about how we shouldn't let past costs affect our current decisions.
Yeah, that one's interesting because of this thing called sunk costs. So that $10 that the bakery originally spent to make that cake, it's gone.
Right.
It's sunk. It's already been spent. They can't get it back.
Right.
No matter what they do with that day-old cake.
Okay.
So when someone comes in and offers $2 for it,
Yeah.
that $2 is relevant because it's money they'll get if they accept the offer
Right.
versus, getting nothing if they don't. And even though $2 is way less than that original $10, in this case, it's better to get something than nothing.
Right.
Right. The original cost is irrelevant at this point.
Right.
So the ability to see the difference between those relevant and irrelevant costs,
Yeah.
that's a hallmark of good decision making.
Okay.
It keeps businesses from getting stuck on past investments or costs that have no bearing on the choice that they have to make right now.
Okay.
It helps them be more agile and forward thinking.
So it's all about looking ahead at what the financial impact of the decision will be, and not back at money that's already gone.
Exactly. Yeah. Focusing on those relevant costs.
Yeah.
It helps managers avoid getting hung up on past decisions or letting costs that aren't actually going to change
You're right.
cloud their judgment.
Okay, so moving on. The outline also mentions capital budgeting.
Yeah.
So what's the main idea behind that?
So capital budgeting is all about, carefully analyzing those potential returns from long-term investments.
Okay.
Stuff like buying new buildings, investing in new equipment, or even launching a whole new product line.
Okay.
And the point is to figure out if these big long-term projects are going to make enough profit over time to justify the cost. Chapter 10 goes into all sorts of ways to do that.
So it's like a way of figuring out financially, is this big expenditure really worth it in the long run?
Exactly, yeah. So it involves predicting those future cash inflows that the asset or the project is going to bring in, and then comparing those to the initial investment and any ongoing costs. And there are various techniques like net present value, which we'll get into a bit later, that help companies make these informed decisions.
Okay. And then there's this idea of choosing what to sell. And it seems kind of obvious, just sell what makes the most money.
Right.
But are there any specific managerial accounting principles that help guide that?
Yeah, definitely. Businesses, they often have limitations.
Okay.
Like they might not have enough production capacity or enough shelf space or enough resources of some kind, so they can't produce and sell every single thing they might want to.
Right.
So managerial accounting gives them tools to analyze how profitable different products or different opportunities could be.
Okay.
They might look at things like contribution margin, which is the money left over from a sale after you subtract the variable costs.
Right.
And that helps you see how much each sale is actually helping to cover those fixed costs and, make a profit.
Okay.
And then they also have to analyze how to use their limited resources in the most efficient way.
Right.
Like we saw with that example in the book, Charlie's Burger Restaurant.
Yeah, I remember that.
Remember, they had limited grill space.
Right.
So they had to figure out which items on their menu would make them the most profit,
Right.
considering that they only had so much grill space.
Right. Which menu items brought in the most money per minute of grill time?
Exactly.
Yeah.
Yeah, that's a great example of how managerial accounting helps make those tough choices about what to sell when you've got certain limits.
Right. Okay, the master budget, that sounds like a really important, like, overarching document for a company.
It is. It really is. So
Yeah.
the master budget, it's the big plan.
Okay.
It's the overall financial plan that brings together all those individual budgets from all the different parts of the company.
Okay.
So sales, production, purchasing, all of that to create, a unified set of financial goals
Right.
for a certain period of time, usually for the year.
Okay.
So it's essentially like the roadmap for the entire company's financial activities.
Okay.
And it includes those budgeted income statements, balance sheets, and cash flow statements.
And the book actually gave a really good example of a poorly constructed budget and then showed a much better revised one.
Yeah, I like that example.
So what were the key takeaways from that?
So the first, the bad budget, it was in figure 1-1,
Right.
and it showed a few really big problems.
Okay.
First, they didn't plan to make enough product to meet their sales goals.
However?
Second, the price they were going to sell it for was too low to cover their production costs.
Okay.
So they were actually going to lose money on every item.
Wow.
And then in the end, they predicted a huge cash shortage.
Okay.
So then they revised the budget, and that's figure 1-2,
Okay.
and it showed how much better things could be if they just worked together a little bit better.
Okay.
So the sales department, they figured out a way to charge a higher price, which was great.
Okay.
And the production department, they found ways to make more products
Right.
and also lower the cost of each one. So the result,
Yeah.
they projected a profit this time
Right.
and a much healthier cash balance.
So it was all about communication.
Yeah, exactly.
And making sure that all the different parts of the company are working together.
Absolutely.
Yeah. Okay. Continuous improvement. That's a concept that I've heard in all sorts of contexts.
Yeah.
But how does it tie into managerial accounting specifically?
So managerial accounting really supports those continuous improvement efforts
Okay.
by giving them the data they need to track performance over time, to find areas where they can make things better, and then to measure whether those changes actually had an impact or not. And that PDCA cycle plan, do, check, act, that's a classic continuous improvement framework.
Okay.
And managerial accounting provides the numbers for that check phase, and then it helps figure out what needs to be adjusted based on what they learned.
Okay.
So the plan phase is about setting your goals.
Right.
The do phase is about putting those plans into action.
Okay.
The check phase is all about evaluating the results and seeing how you did. And the act phase is all about taking corrective actions based on what you learned.
Gotcha. So can we walk through like a specific example, like Ripe OJ from the book?
Oh, yeah, let's do it.
How would that work?
So Ripe OJ, they had a plan to try out a new juice extraction technology.
Oh, okay.
And their goal was to get more juice out of every orange.
Okay. Sounds good.
Makes sense, right?
Yeah.
So they did it. They put this new technology into their factory.
Okay.
And then came the check phase. And they measured how much juice the new technology was giving them compared to their old method.
Okay.
Unfortunately, it turned out that the new tech was actually giving them less juice.
Oh.
So the act phase would involve figuring out what to do next.
Okay.
Do they abandon this new tech altogether? Or maybe there's a way to modify it
Right.
and try the whole process again. So managerial accounting, that's what gives them those numbers, those gallons of juice per orange that they need to do that check step and to make those future decisions.
So it's a really data-driven way to constantly refine things.
It is. It's all about having the data to back up your decisions.
Okay. The last thing in chapter 1 that I wanted to touch on was this idea of a code of ethics. Why is it so important to have a strong ethical framework, when you're talking about managerial accounting?
Because managerial accountants, they have access to really, really sensitive information.
Right.
That can have a big impact on decisions being made in the company and even on the livelihoods of its employees and, everyone who has a stake in it.
Right.
So the Institute of Management Accountants, or IMA, they have a whole code of ethics that outlines those important principles like honesty, fairness, objectivity, responsibility.
Okay.
It also talks about things like confidentiality, not disclosing secret info unless you're legally required to.
Right.
Integrity,
Right.
meaning you avoid conflicts of interest and you don't do things that would compromise your ability to do your job ethically.
Right.
And credibility, making sure the information you prepare and share is accurate and reliable.
Okay.
And sticking to this code, it's absolutely crucial
Yeah.
because it maintains trust within the organization. And it makes sure that the financial information that management relies on is accurate.
Right.
If that trust is gone, the whole system can be compromised.
Right. Like if you don't have that trust, it all kind of falls apart.
Yeah, exactly.
Okay, so let's move on to chapter 2, using managerial accounting in your business. So the first thing it talks about is how to classify different businesses based on their output.
Yeah.
So why is this classification important?
So what's interesting is that the core of what a company makes or does directly affects the kinds of costs it's going to have, how it'll measure its profits, and even how it assesses its efficiency.
Okay.
So the source, it neatly puts businesses into 3 main types based on what they produce. Service companies, retailers, and manufacturers.
So just to recap, service companies are all about doing things for customers.
Yeah.
Retailers focus on selling products they've bought.
Right.
And manufacturers are the ones actually making the products.
Exactly.
And restaurants, they often fall into both, right?
Yeah, they're a little bit of both. So, a consulting firm giving expert advice, that's a service.
Right.
A grocery store selling food, that's a retailer.
Okay.
And a car factory putting those cars together, that's a manufacturer.
Right.
But restaurants, they do both. They take raw ingredients and they make food, so that's manufacturing.
Right.
But then they also serve that food to customers, so that's a service.
Okay.
And understanding this basic difference, it helps us choose the right tools from managerial accounting
Right.
that are most relevant for each type of business.
Okay.
So you wouldn't track raw materials the same way for a consulting firm
Right.
as you would for a bakery that's using flour and sugar and all that good stuff.
Okay, yeah, that makes sense. So the chapter then goes on to talk about measuring profits. What are some of the key components we need to understand there?
Okay, so to understand how profitable a company is, you start with their revenues.
Okay.
And that's all the money that comes in from their customers.
Okay.
Basically what the customers pay for their goods or services.
Right.
Then we've got the cost of sales, which are those direct costs that are specifically tied to making that revenue.
Okay.
So for retailers and manufacturers, that's often called the cost of goods sold,
Okay.
which is just, what it costs them to make the stuff they sold.
Okay.
And the difference between the total revenue and the cost of sales, that gives you a number called gross profit.
Okay. And gross profit isn't the final profit number, is it? There's still more to consider.
Yeah, there's still more to factor in. So to get to the net income, which is like that bottom line, that
Right.
overall profit or loss for a specific period, you have to take out all the other operating expenses from that gross profit.
Okay.
So those operating expenses include things like marketing costs, administrative salaries, rent for the office space.
Okay.
So the book is a really simple formula.
Yeah.
Net income equals revenue minus all the expenses, including that cost of sales.
Right. Okay. And I thought that example with Al's used cars was really helpful. It showed that progression from revenues to the cost of goods sold and all those other expenses to get that
Yep.
final net income.
Yeah.
But the book also makes a really important point that just because a company has a positive net income,
Right.
it doesn't automatically mean that they have positive cash flow.
Right.
So why is that distinction so important?
Oh, that's a really crucial point.
Mm-hmm.
So net income, as we discussed, that shows the revenue and expenses, as they're recognized according to accounting principles.
Okay.
But this doesn't always line up perfectly with when the actual cash is changing hands.
Okay.
So, for example, a company could make a huge sale to a customer on credit, which immediately boosts their revenue and contributes to a higher net income.
Okay.
But they might not actually get that cash from the customer for 30 or even 60 days.
Right.
On the flip side, they might pay a lot of cash up front for a new piece of equipment, which is an asset that they'll use for many years. And its cost won't be fully reflected as an expense in that current period's net income, even though it's a big chunk of cash that went out the door.
Okay.
So it's totally possible for a company to look profitable on their income statement, but still have trouble paying their bills if they're not managing their cash flow properly.
Right. It's not just about the profit on paper. It's about having the actual cash when you need it.
Exactly. Profit doesn't always translate directly into cash in the bank.
Yeah, that's a good distinction to keep in mind. So the next section in chapter 2 talks about considering efficiency and productivity. And those sound pretty similar, but what's the real difference between the two?
So efficiency, it's mainly about minimizing waste and getting the most out of your resources.
Okay.
It's about doing things right and using the least amount of inputs.
Okay.
Productivity, on the other hand, is a bigger measure.
Okay.
It focuses on how well a company is doing overall in terms of generating sales and profits from its assets.
Okay.
It's about making smart choices to maximize your output relative to the resources you've invested.
Yeah.
The book uses this analogy of a goose that lays golden eggs,
I remember that.
which I think is a great way to think about productivity. It's about generating valuable output with minimal investment.
Yeah, like don't kill the goose that's laying the golden eggs.
Exactly. You
Ah,
want to keep that goose happy and productive.
yeah. So you could be super efficient at making something,
Yeah.
meaning you use very little material and labor.
Right.
But if nobody wants to buy it, you're not really being productive.
You're right. You can be super efficient at making something that's completely obsolete
Right.
or that there's no market for,
Right.
and that wouldn't help the business at all.
Okay. So the discussion about productivity also brings up the cost of capital. So can you explain what that is?
Sure. So the cost of capital is basically the average rate of return that a company needs to earn on its investments to keep both its lenders and its investors happy. So if a company needs money, to run its operations or to invest in new things, it typically has two main options.
Hmm.
It can borrow money,
Right.
and in that case, it has to pay interest, or it can sell ownership in the company,
Right.
which is issuing stock, and then the shareholders expect a return on their investment,
Okay.
either through dividends
Right.
or the stock price going up.
Okay.
So the cost of capital, it's like the weighted average cost of all those different ways of getting money.
Okay.
It's usually shown as an annual percentage.
Okay.
And for most companies, it's somewhere between 6 and 15%.
Okay.
So any new investment they make needs to make a return that's at least equal to that cost of capital just to break even, considering their financing costs
Okay.
if the return